Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Hello, everybody, and welcome to the November episode of Cup of Joe. We're so glad you're with us this month. We've got a jam-packed agenda, as always. I'm Mike Carrazzo, joined by the happiest man in metal.
Oh, that's a new one. I appreciate
Yeah,
that.
yeah. I feel you're always getting, Dr. Doomed, and you got people say you got the glasses on that are just kind of, pessimistic. So I find you to be a very happy fellow.
Hey, what's not to be excited about right now? We're heading into the holiday season. We got
Yeah.
Thanksgiving right around the corner, Christmas. It's just a good time to be alive. Yeah, and why
Yeah.
not bring a smile to the metals world?
Yeah, I mean, just coming off of Halloween, right? I think it's going to snow here in Chicago on Sunday, I think.
I heard the same. Did you dress up for Halloween?
I didn't this year. I didn't.
No.
No, normally I would with the kids, but this year we didn't do, they just kind of did their thing. But my wife and I did not dress up this year. I've done Batman in the past, and forget what I was last year, but I've been Batman a few times. It's a
Okay.
safe costume. I like it. How about yourself? Did you dress up? Did you wear your
I
wig?
I didn't this year. I really wanted to go as a Labubu this year. I just learned what that was in the last couple weeks. Um,
Yeah.
but I just couldn't get the materials together in time, unfortunately.
Yeah, you need the nine teeth. That's what my daughters tell me.
That's right.
There's the fake ones that don't have nine teeth. So
Unbelievable. And
the
apparently they have lead
Lafufu.
in them as well, the Lafufus. Yeah.
Yeah, yeah. So don't go eating a Labubu's. But we've got lots to talk about, right? We've got turkeys, we've got inflation.
That's right.
But what I'd want to before we dive into this, if you don't mind, Nick. So
Why?
if our producer Jason Pounders has the link, I'd like him to share it in the chat. So what we'd like, this is a great audience. I feel like it's been a community here for gosh, it's got to be going on nearly 50 shows here. And we really we'd like to continue to grow. And we've really found that a lot of our listeners, as they kind of spread the word, has really helped us out a lot. And we have a LinkedIn post that we put up today on Ryerson's LinkedIn, just talking about the show and what we're all about. Because it's funny, we did a LinkedIn poll last week about how often do you listen to Cup of Joe. And I tell you, there was a handful of people that said, "What is Cup of Joe?" And we can't have that, Nick. We've got to have everybody in the metaverse knowing what Cup of Joe is all about.
It sounds like we got a bunch of liars following us on LinkedIn.
Yeah, right. Yeah. Well, the good news is there's a lot
I'm
of people
kidding.
that tune in.
I'm kidding. I'm kidding.
That tune in. So we've got a post in the chat. Now, what we'd like you to do is all you gotta do is share that and maybe say something to your audience. Say, hey, I'm a Cup of Joe listener and this is why, or definitely share this along. And we're gonna pick somebody, a lucky participant to receive some Cup of Joe swag. So if you could send that in the next week, that would be great. Sharing for the holiday season coming up would be very helpful.
I love it. I'm going to be doing it as soon as we hop off this podcast here today.
Oh, disclaimer, you can't win.
Ah, what? Well, hopefully I can still enter some opportunity to get a cup of Joe swag, maybe some RY Joe or something like that.
Yeah, not bad. Yeah, definitely. Yeah, so it's in the
Excellent.
chat there. So definitely check on it and click and share with your friends. We definitely appreciate it.
Awesome. So with that, I'll go ahead and kick it off with the content. So hopefully you're all able to see my screen here. We do actually have a theme for today's Cup of Joe, and that is what's a Fed to do? Hyperscaled and hyper concentrated. If that's not glaringly obvious just yet, hopefully over the next, I'd say 15, 20 minutes, you'll have a better idea of what I'm referring to with regards to this hyperscaled, hyper concentrated world that feels like we are in at the moment. Before we get into that content, we have to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, These are not the opinions of Ryerson. I'm going to give a lot of spicy opinions here today. Hopefully not too spicy.
Right.
And we're going to talk turkeys. We're going to talk turkeys here in a little bit. But we got a lot of great content. We got a lot of good metals content. There's actually a fair amount going on in some of the metals that we watch. So we will get into that in great detail, and hopefully we get some good Q&A dialogue as well. So first things first, as we often do, we've got the global PMIs. Admittedly, not a real big change when we look at the global figure. It's gone from 50.7 to 50.8. Very modest optimism, I'd say, within the global manufacturing PMIs. If you peel back the onion and look at certain regions, the slight strength in the United States has shown over the last, I'd say, 2-3 months. And we have seen Canada, Mexico get a little more optimistic. They were looking at like pretty rough territory as we were in sort of the March through July timeframe. As we were going into Liberation Day, we had all the protectionism. I think things really took it on the chin within those two regions for several months. They're still back in negative territory, but they are in a little better spot than they would have been in midsummer, let's say. And then as we often like to point out, India, I don't know if they just have their finger stuck on the yes button or what it is, but their numbers just continue month in, month out to print extremely strong. They're up at 59.2. So their manufacturing PMIs are going gangbusters, and they really are the bright spot around the world with regards to this survey data.
Although their steel production seems a little, there's some news that, so as we always do before the show, we trade headlines back and forth. One that kind of caught my attention was India saying that domestic steel, basically the global, there's almost like too much supply out there, and the price of steel domestically is going down. I think we're going to get into some of that later, but I thought that stuck out about, are they producing too much steel and can't sell it?
Yeah, and I think that's really a global phenomenon. We'll obviously get into steel in more detail here in a little bit, but I think it just remains the case that given the current demand structure around the globe, we still have an oversupply issue. And I'd say it's still centered in the normal spots, the normal culprits, which would be China and Asia, which is just the lion's share of global production. And it's extremely low pricing. So it is attractive to consumers. Admittedly, India has ramped up a lot of steel production over the last several years. You could maybe make the argument that they've over ramped up, particularly given the fact that China is still exporting their excess supply. It wouldn't totally shock me if we start to see other nations sort of following suit to what the U.S. has done, which is sort of put up the protectionist walls to a degree to protect their investments in local industry.
Yeah, interesting. Okay.
Looking at the ISM figures, so we're going to have both the ISM manufacturing figure as well as the services. The manufacturer side of things is still a bit squishy right now. It is a little softer than what the S&P global figures were showing. We are seeing a headline figure of 48.7, which is year-over-year weakness. I will say that the new orders number, I've kind of shaded it a pale green color because it's not in growth territory, but it is giving some potentially early signs of life that new orders may be improving and creeping towards that growth area. But when you look at other areas like employment and you look at prices, both of those categories are quite weak. And that'll be something you'll see as a theme here today, which is whether we're looking at manufacturing or we're looking at services, the employment picture seems to be softening and prices really just won't quit in terms of inflationary impacts to the economy. So when you look down at the bottom section of this, the overall economy, mostly lifted up by the services sector, is doing still very well and has been for about 5 years now. But the manufacturing side continues to be a little bit restricted and is facing some headwinds. As we look at services, it's a mostly different story in terms of the headline activity and the new orders, which are quite strong. This is really what's been the tailwind for the economy, is the services side of things. But again, this theme of weak employment, we are seeing that contracting a bit, and then prices being exorbitantly high. A survey reading of 70 is incredibly strong. You can see it's really been in the strength area for a while, but that is starting to perk up a little bit again. Which, this is really where I come back to what does a Fed do? You're sort of stuck between a rock and a hard place where you kind of have to make the decision of, do we address the slowing employment picture, or do we keep rates higher and try and put the lid on inflation? And it is a pretty tough spot to be in. And then we'll get into the sort of the hyperscaling, hyper concentration part here in just a few slides. But as we look at inflation, this is going to be your headline inflation figure on a year-over-year basis, which is showing just over 3%. For those who have tuned in with us in the past, 3% still above where the Fed's target is. Their target vocally, publicly is somewhere closer to 2%. And what's a little worrisome is it doesn't look like a whole lot, but in the last 4 or 5 months of data, we were beginning to see that figure not just flatline, but it's actually ticking a little higher. And some of that's coming from some core goods inflation that's perking up. Not much from energy at this stage, although well, certainly not from crude oil. Crude oil is basically stuck at $60, but we are hearing some signs of natural gas and electricity prices turning a bit higher. So, this is definitely a concerning trend if that is to continue for the Fed, because, as we've talked about in the past, we are in a rate cutting cycle. And it's a bit of a head scratcher to be cutting rates in the face of what looks like a slightly rising inflationary picture. And speaking of inflation, we can't talk in the month of November without talking about turkey and Thanksgiving dinner. This over here on the left-hand side, this is the average cost of a Thanksgiving dinner for a group of 10. And over on the right-hand side, you can see all the categories that's been attempted to keep kind of a stable basket over the time frame, so that you're getting an apples to apples comparison over a longer period of time. And what I found fascinating, I hadn't looked at this in probably a couple of years, but we are continuing to see I'd say fairly rampant inflation in the cost of a Thanksgiving meal. And the annualized rate going all the way back to 1980 is about 5.4% annualized, which is well in excess of where traditional inflationary trends would be. Now, doing a little digging into this, I learned that just in the last 12 months, we are seeing about 40% price increases in the cost of a turkey. So for those who are stuck on, really loving that turkey at your Thanksgiving meal, it sounds like it is going to be at a premium versus last year. And a lot of that's going to be due to the bird flu, which, in my research, sounds like it took out about 3 million birds over the course of the last 12 months. So things are tight within this space. So I know that's not lovely news to hear, but Mike, I heard you're actually hosting Thanksgiving this month.
Yeah, yes. We for the past few years, we used to host it a lot. Past few years we have not. And then this year, my wife's family coming in town from Arizona, from Minnesota, right? So we said, oh, let's host it, right? And we talked about that today. I was like, well, as luck would have it, the turkeys are going up 40%. So may have to just bite the bullet. Gotta. It's once a year, right? You got to get the turkey. And
that's right. Well, you said bite the bullet. I was gonna make the suggestion, maybe you put on your Elmer Fudd costume and go hunting for one.
Go hunting for one, yeah. Not a bad idea. And
again, these are the opinions of Nick Webb and Mike Crosser, not the opinions of Ryerson. Only go hunting if you do so in a safe manner. But nonetheless, we just want to have a little bit of fun with this. But it remains the case that, whether you're looking at turkey prices, you're looking at beef prices, or just inflation in general, it is remaining a pesky thing for the economy. So all jokes aside, we know that this is something that is very serious and is something that we want to take seriously. But we because it's our podcast, we like to have a little bit of fun with it on occasion as well.
That's not to lie, right? You go shopping and it's still, I haven't seen a big drop in prices at all. The eggs, right, were the big thing a few months ago, and I think that was attributed to the bird flu. But apparently that's still carrying over here for the turkeys.
Well, yeah, and we want to blame bird flu, but I mean, I saw something just a couple of weeks ago that said that somebody this time last year was in a Costco within the last couple of weeks. So this time last year they were in a Costco, and they were looking at the price of a ribeye, and I believe it was something like $19 a pound last year. It's up around, I think it was around 32 this year, which again, that's
wow.
That's an area that's seen some pretty rampant inflation as well. So yeah, it's not just the turkeys. So I'm not just going to blame those guys around Thanksgiving.
Maybe go Elmer Fudd.
That's right.
Shoot some cows.
Yeah, and similarly, we talked about this in a lot of the PMI data, but the employment picture does continue to soften. We've in the last few weeks seen a lot of big companies announcing some pretty hefty layoffs, and just a quick example. Amazon just in the last week announced that they were going to do corporate layoffs of around 30,000 people. Pretty big numbers. So obviously they do employ a lot of people. So maybe on a percentage basis, it's not real concerning. But from a numerical standpoint, they're a massive employer in the United States and around the world. And It's a big number. And when we look at the data, so unfortunately, and I probably should highlight this, some of the data we often look at, we don't have access to currently because of the government shutdown. So things like the JOLTS job openings data, we don't have the latest figures on that. So we have to kind of rely on other private data. And in this case, we're using Indeed, which is sort of a hiring HR software company. And based on their data, which seems to correlate pretty darn well to the JOLTS data, it is suggesting continuing softening. And if we look more broadly at things like continuing jobless claims, a lot of different categories seem to be suggesting that things are softening a little from an employment standpoint.
What was the scary? I thought it was kind of scary. The stat you shared last month about kind of the advent or the debut of ChatGPT, right? And where the job trend line started to go and jobs started to dip.
Yeah, and I've got another one that's similar. And this may be where I put on my Dr. Doom hat, but this is something similar to what we looked at last month, but it's a slightly different way to look at it. It's a little bit of a busy slide, but basically the top section of this visual is showing the S&P 500, so the stock market, in blue, and then the orange line is going to be the University of Michigan Consumer Sentiment Survey. And we've touched on both quite a bit in prior Cup of Joe podcasts, but you can see that when you look down on the bottom section, this is showing the correlation or the relationship between the two. And I think it makes sense. More often than not, it makes sense that if people are feeling good about the economy, there should be some semblance or some spill through to a stronger stock market. I think that from a very high level makes sense. The stock market is by no means an exact reflection of the economy, but I think there's absolutely a relationship between companies making good earnings and people feeling good about the economy. More often than not, that is the case. But as we look right now down in the bottom section, we are in a very inversely correlated situation where for the last several years, people are feeling pretty crummy about the economy, and yet we continue to hit all-time highs in the stock market. So I want to spend a little bit of time, sort of diving into what sort of phenomenon may be occurring there. You touched on the AI one, and I think that could be a very real one where, maybe people just feel less good about their productivity or their life, given that they now have, artificial intelligence doing some of the things they may have been doing themselves and feeling a little better about themselves. Could be that AI is taking some of the employment out of the picture, which is absolutely a possibility. I think there are some other situations or other examples. One I'm shown here, which is saying, yes, the stock market might be right within spitting distance of all-time highs, but what's driving that is seemingly a much smaller and smaller cohort of companies that's really taking us to those levels. This chart is showing, going back to 1980, the percentage makeup of the top 3 largest companies in the stock market. You can see they've changed over time. You've got ExxonMobil in a couple of these. You've got Walmart in one spot. And the composition has certainly moved into much more of a technology-based index. But when we look at NVIDIA, Microsoft, and Apple, those 3 companies combined from a market cap standpoint make up 22% of the S&P 500. So essentially, the stock market is really getting much more comprised by a smaller number of companies. So, I think that's part of what's explaining this, where you may have in the S&P 500, you've got 500 companies. The top 10 may be they may be driving, 70, 80, 90% of the movements in the stock market, just because they're so heavily weighted. Whereas you could have, the other 200 or 300 or 400 that aren't really doing all that well, or maybe even experiencing some semblance of like a recessionary type condition. And I'm not saying that's exactly what's happening, but it's definitely, it's moving that direction. And you can see it pretty visually. It's been taking place essentially since the COVID lockdowns.
Yeah, but since 1980, that's the largest percentage that 3 companies have comprised of the.
Yeah. And you can cut this a lot of different ways and say the same thing, but if you expanded this out to the Mag 7, it would tell you a similar story. But really it's highlighting this fact, which I think this does a really good job of walking through the disparity. Over here on the left-hand side, I saw this last week and it's just kind of mind blowing, but on average, 1 in 2 NVIDIA employees, just given the fact that they've been issued, shares of the company, 1 in 2, 50% of NVIDIA employees are currently worth over $25 million, which is kind of mind blowing. when you say that, there's no way that those individuals who are worth that amount of money are really concerned about inflation at all. You know, they've become extremely wealthy over the last 10, 15 years, and good for them. They're working for a very productive company. You know, the technological advancements that they do are changing the world. There's no doubt about it. But you have that going on one hand, and then on the right hand side, you do have the situation where, as we sit here right now, approximately 54% of Americans save less than 1% of their household income. And within that, you've obviously got some semblance of that, or some piece of that pie that isn't saving anything. And then you have about 10% of that that's actually in negative saving, which means they're going deeper into debt. So, I don't want to drive this point home too hard, but essentially you do have both a stock market as well as what I think an economy where, again, the idea of hyperscaling, hyper concentration. There are, let's say, roughly 2 million employees within the high tech sector that are all feeling quite good about their world and their employment and their wealth. You have another, if we're saying 54% of Americans, that's let's call it 150 million people who aren't really saving any money. And if they're not saving any money, you can imagine what the impacts of inflation are going to have on somebody like that, which is a much larger number of people. So I do think that is where we're getting this divergence in how people are feeling about the markets. It's leaving a lot more people behind at the moment.
Hey, Nick, circle back to the jobs real quick. We had a question from the audience that does the job data that you showed, does that include government jobs, or are we just talking private sector?
Let's see. On the Indeed data, I believe that actually does include the government sector.
Does it? Okay.
Yeah.
Okay.
And again, there are a variety of ways that we could splice that data. We could look at jobless claims, continuing claims. ADP puts out some data. All of them are generally telling a similar story, and that is that, despite the fact you may have government hiring, we may even right now have some seasonal holiday employment taking place. Despite all those things, if you adjust for seasonality, I think things are softening.
Yeah. Okay.
That being said, I'm seemingly talking bad about big tech, and I certainly don't want to make that seem too evident, but because in reality, those companies are also spending the lion's share of the money with regards to capital expenditures. This is showing just the four big ones. So Meta, Facebook, Amazon, Google, and Microsoft. And you can see over the last just couple of years, the amount of growth that they are spending and that they expect to spend in 2026. And this is on things like data centers, like, power plants, like hopefully building out the electric grid and things like that. But the numbers are staggering, that we're up close to 500 billion in expected capital expenditure spending for next year. And that's going to consume concrete. That's going to consume steel. That's going to need industrial equipment, the Caterpillars of the world. And I will say that spill through is real. And there are companies that are benefiting because of this spending. So it is having a benefit to the real world economy as well. I don't want to just say this is pie in the sky. We're moving in an AI world. Nobody else is going to have jobs. There is spillover for sure. What's interesting is, and I saw this just a few days ago, where that spillover is actually occurring with regards to where data center buildouts are taking place. Wild stat here, within 33 counties, so that's counties across the United States, represents 72% of the current data center buildouts across the nation. So it almost seems like there are certain parts of the country where they're like, we are open for business. You want to put your data centers here, do it all day long. And I'll tell you, I was back in Ohio very recently, and I was heading down Route 23 for anybody who knows it. And I was going to my hometown of Circleville. And that's one of the areas where they've essentially just opened up the window and said, you want to build here. And I will note it's not particularly attractive from a visual standpoint, because a lot of these things are just massive buildings with, energy tanks surrounding them. But in terms of what it can mean in terms of, revenue for the city, revenue for the county, I think it can be pretty meaningful. But yeah, I was kind of blown away by how just segmented this map was for where we currently have data centers.
I know there's a ton being built out in Texas, got a call coming in.
He can wait. He must not be tuning into Cup of Joe today.
A ton built out in Texas, and to your point about how it impacts the average person. I think you were discussing, right, that like data centers being built out could really start to ramp up the electricity bill of those that are kind of in the area of these.
It certainly could. I mean, all of these things
Yeah.
are going to have knock-on effects, but hopefully that means more construction jobs into building out, power lines and power infrastructure for these, and hopefully that does equate to more jobs. I think the big question mark right now is not necessarily whether or not that money is going to be spent from the hyperscalers. It certainly looks like it's taking place in 2026. I think the question is, are they going to be able to generate a return on their investments? I think that's still up in the air, and we're all waiting to see. And I think certainly the markets are waiting to see if that takes place. But the good news for the metals world and for the manufacturing world is it looks very much so, based on some of the things we're hearing, we're seeing that a lot of this money is going to be spent and deployed into manufacturing these spaces next year. And perhaps no coincidence, I think that's really one of the reasons why we are seeing the Dodge Momentum Index move to all-time highs, which should have a trailing reflection on non-residential construction. So I think this is one area where we can say, yeah, this bifurcated world of tech doing really, really well and everybody else not doing well, it doesn't have to fully play out that way. We could have a scenario where anybody working in these construction spaces should actually see some pretty nice 12 to 18 months, maybe longer, as we roll through the next few years.
Yeah, data center is pretty metal intensive too.
Sure is.
That's a big deal for this market.
Yeah. Now, coming back to the Fed, how we've seen a couple rounds of rate hikes over the last several months. As we sit here right now, we look forward to the next meeting, which is December 10th. The expectation still is that they're leaning more towards a cut than a not cut. It's about 70% odds that they are going to cut. So for now, it's looking like the Fed is prioritizing the weakening employment picture. They're going to continue to accommodate that side of things, and sort of put the importance or the severity around the inflation data perking a little bit back up to the side for now. So it will be very interesting to see as we roll into like Q1 to see how the Fed's approaching that.
Is that cut number 4 this year?
That would be, I believe it's number 3.
Number 3. Okay.
Yep. And last but not least, I want to bring all this home to say, despite all this that we're seeing, the haves and the have-nots, and it is a very wide divide, and I do think it is probably something that needs to be addressed. All that being said, when we take a look at just the overall U.S. economy, this is the Atlanta Fed GDP tracker. It's still up close to 4%, which is a pretty darn good number. Assuming that continues into the coming quarters, it's not all bad. I mean, certainly there are some headaches and there are some headwinds coming with regards to employment. And obviously inflation is certainly painful, but growth in the economy is still holding up pretty well. With that, we're going to switch over to the metals world. So as we often do, we're going to look at U.S. steel prices relative to pricing around the globe. That orange line down there, that's the one that we talked about at the onset of this podcast, which is Chinese prices are still just rock bottom. There's very little chance that many of those steel mills in China are making money. And a lot of that material probably is flowing into places like you noted, which would be India, and kind of undercutting their own industry. But here in the United States, where we have 50% tariffs and domestic pricing right around $850, the U.S. market's still pretty insulated from foreign threats. And when I say threats, if you look at Northern Europe right now, pricing's in the mid to low 600s. If you slap 50% tariffs on that, put $100 on top of that to get it to the United States, that material is not really arriving anywhere sub $1,000 a ton. Now, I don't think that means that U.S. mills are immediately going to take pricing straight to $1,000 a ton to close that gap, because I just don't think the demand environment is really warranting it. So I think maybe I give the mills a little bit of credit where they're not trying to gouge and take things straight up there. But it feels like somewhere in the 850 to 950 range is where we're probably going to be going for the next, at least for the next several months is where I'm seeing things.
That's what's really holding it steady, right? Is demand is not high, or we would say the demand is slowed, right? So I mean, that makes sense that it's not gonna, the mills won't bring it up to that, because that's just not. And I think mills are being somewhat responsible in trying to keep utilization rates a little subdued just to match that weaker demand environment. But because if demand was going gangbusters, you would probably see pricing in excess of $1,000 on a hot roll. But the fact that we aren't seeing that kind of tells you
really where the overall demand environment is.
Do you get any kind of indication about next year, early next year, demand levels? What folks are saying? Do you think it's going to come back strong, or?
I think you get a little bit of a tailwind from just the fact that we should have a better idea of what the tariff landscape is going to look like, the rules of the game in the next year. So I think that'll be a small aid to things.
Sure.
We've beaten it like a dead horse, but there are going to be aspects of the economy that are going to do very, very well. It seems anything that's data center tangential should be doing quite well. So industrial machinery, anything regarding power equipment should be doing well. So it feels like it's, from what we can tell right now, it feels like it's going to be kind of more of the same, where it's certain aspects of the economy are going to be doing quite well, and then others might have a little bit of a tougher time.
Yeah. Okay.
When we look at steel futures in the last 30 days, we have seen a small perk up in pricing, mostly on like the Q1, let's say January through maybe May, where pricing has moved higher by about $15-20. We've seen a couple mills announce price hikes. We've seen Nucor CSP move up by about $15 in the last 2 to 3 weeks. So there's a small tinge of optimism that we may have seen the lowest pricing of this cycle in the last, let's say, 30 to 45 days. I don't see the landscape really suggesting we're going to go too far beyond something like a $900 on hot roll. Maybe that changes if you get a lot of stockpiling as we head into year end and beginning of next year. But for now, it looks like a pretty balanced market. Not a whole lot really to note, but just small bits of optimism with regards to pricing. Now, I touched on this last month. I wanted to revisit this for a couple of reasons. One's kind of interesting or funny, but the one that isn't as interesting or funny, we want to be certainly respectful of this, because Algoma is a supplier of ours and has been for quite some time. But I noted the fact that last month they had announced that they were effectively pulling out of the United States market. And that was just because with the 50% tariffs, they're a Canadian mill. The pricing at which they would have to sell into the US before tariffs was just so low that they weren't making a whole lot of money. Now, the unfortunate side of doing that, because they're doing it for reasonable business reasons, is if you don't have the US market to sell into, is there the demand within just Canada to absorb what they're producing? Or can they figure out a way to pivot into a new market? And we had talked about the idea that they might pivot into something like more rail, more long products. And at least from the market's perception, they're not really thinking that that's a great strategy. I would say that from an Algoma standpoint, from a current U.S. administration standpoint, it still feels like the goal in all of this is for Canada and Mexico to put up their own similar protectionist walls that would look much like the United States. So in other words, Canada would announce their own tariffs that basically replicate what the United States is doing with other regions of the world. If that were to happen, if that does happen, I think it does two things. I think it could obviously force Canadian citizens themselves, Canadian companies themselves, to actually look inward and buy much more domestically produced product. I think the other thing that it does, it might be the step that's necessary to actually bring the walls down between Canada and the US, to actually get a USMCA agreement. If both of them are approaching the world market in the same way we are, that might be the type of thing you'd need to see in order to have us be a cohesive North American unit. And then at that point, Algoma and or any Canadian company could then participate in business with the United States without those tariffs. That's at least my opinion. But I thought we're not here to talk stocks. We're not here to talk about Algoma and whether or not they're doing well or not. But I think it's a good anecdote to describe the trade situation and the things that are being asked for and requested, and the struggles that are coming because of these trade talks, honestly.
Well, it's interesting, right, that we noted earlier, you and I, when we were discussing, it looks like the European Union has instituted or wants to tariffs of their own, right? So it seems like we're seeing this more and more. And if I'm hearing right, you're saying if they put up those walls, if you will, then it could create a better's not the right word, but it would open up the import market, or basically the free trade market within North America.
Yep. Yeah, I think that's exactly right. And the funny anecdote that I was going to share, again, this is just something I came across. My analyst actually sent it to me just yesterday, I think. It is public, so we're not sharing anything that's like the rumor mill or anything, but it's an interesting scenario. There's an individual Barry Zeckelman. He runs a company called Zeckelman Enterprises. They're a tube company. They make pipe and tube, and he's a Canadian resident and a Canadian citizen. Has a lot of operations here in America as well, though. But one of the things that he put out to the public was I'm paraphrasing, but in so many words, he basically said, if anybody is aware of any government-related projects that are consuming non-Canadian steel, so this is within Canada, any Canadian governments that are working on construction projects that don't use Canadian steel, take a picture of it, send it to me, and you will be entered to win to receive $1,000. Mm-hmm. Now you'd say, why in the world would he be doing this? Why is he putting out this message? Well, it sounds like, and this is my personal opinion, it sounds like he's looking to use all of these photos and all this evidence as a way to then go to the government and say, look at all this laundry list of reasons why you should be sourcing from North American supply chains, not foreign supply chains. That's what it feels like. I just thought that was kind of a funny anecdote because it does sort of fit into this whole scenario that we're talking about, where it seems like there are some individuals on the supply side who are kind of saying, maybe we should look at putting up our own walls. Maybe we should look internal for our supply chains. But it's a very funny and unique way to go about it, I guess.
So if you see a bunch of Canadians inspecting the rafters around hockey arenas or wherever, punching holes in the wall to see where the, made in Canada, that's what that's all about. Yeah,
this is not investment advice from the Cup of Joe team. Please don't be out there climbing rafters. But yeah, that is something that, and I think they've even got it on their website as kind of the request and the call out to everybody, which is fascinating.
Yeah.
So we'll leave that one there because that's a funny topic. But so we've talked about this a couple times just today, but we are continuing to see production levels within China drop. It's a little difficult to see, but this light blue line, this is a seasonal chart, so it's showing Chinese steel production versus the last 5 years, and you can see that for the last, let's say, 5-6 months, we have seen a continuing theme of China is rationalizing their production. In my opinion, not enough. They are still exporting huge amounts of steel, but it is moving the general direction that I think the global demand picture probably needs in order to get a little bit more balanced. When you think about the Chinese prices being down around $400 a ton, it's kind of still suggesting that they haven't done enough to balance out markets. But this chart kind of suggests that the trend is going in the right way, but probably needs to continue for quite some time ahead.
You talk a lot about smelters, and I think it's on the nickel front. It's like the cost to profitably make that. I mean, I'm thinking making steel at $400 a ton can't be very profitable.
No. I mean, when you consider the fact that iron ore is trading on either side of $100, you've got scrap price. I mean, scrap alone here in the U.S. is trading at $380 to $400. Yeah. Scrap in Turkey, which is really the global market for scrap, is probably around a similar. I'd say 375 or so. So yeah, there's very little chance that when you have a scrap market of your finished product trading at the same price, you're probably not making a whole lot of money.
Yeah, it's fascinating.
Yeah. You mentioned nickel. Flipping over to nickel, I don't have a whole lot new to say here. We've really been in this range for the last 6-7 months, which is right around $7 a pound. We are continuing to kind of grind along the bottom. But with that said, Indonesia continues oversupplying the market. Inventories on the London Metal Exchange continue to grow pretty much month in, month out. That being said, we have in the last few days at least seen the anecdotes that Indonesia is taking note that they are oversupplying the market. They are aware of this. They probably don't, they themselves, nor do any other nickel miners around the world, love the fact that they are drowning the market in nickel products. And they're recognizing that as well. And I'm not going to read all of this, but basically Indonesia's officials have basically said, we are going to look into making sure that our mining industry, our nickel processing industry does more to refine the products into value-added things, not making these what they call intermediate products like nickel pig iron, nickel matte, and instead make a value-added product. And hopefully, I think their goal ultimately is to rein in a little bit of the production. We're not seeing it within the data. We're not seeing it within inventory data. But I think this is the feel of what that announcement is. It's their idea that, hey, if you're going to keep mining nickel, you're going to keep extracting out of the ground, get your money's worth, actually process it into a more high value added component or product, and sell that into the global marketplace. So I think all of this kind of has the essence that they're trying to take some sort of action on this. It still very much just seems as though they want to control the global nickel and stainless market. But this is just one measure to say, we hear you. Prices are pretty beaten up. We are probably in need of making some adjustments. Last but certainly not least, although yes. I guess I have a copper chart, so this isn't even last.
I just like when you say it.
We looked at a very similar chart to this last month, but this is showing the London Metal Exchange aluminum ingot price in white. And then the blue line is going to be the price of aluminum ingot in the United States. So that is the London Metal Exchange price plus Midwest premiums. Very, very obviously, you can see that it's opened up like an alligator mouth. And that is purely a function of tariffs, 50% tariffs on aluminum ingot getting implemented. Those tariffs have to be covered. Those tariffs have to be paid. And because it's 50% and you have a slightly rising LME price, those two are kind of compounding on one another to create where we are right now, which is all-time highs on aluminum ingot here in the United States. Now, what's a little ominous is you look back to the last time we were up here on this blue line, this Midwest transaction price, which again is the LME plus the Midwest premium. We got up to right around this price level. I think it got to $2.18 4 years ago, but we didn't stay there very long. And I don't know what's going to happen in this time around, but we've talked about this saying quite a bit, which is the cure for low prices is low prices. The idea being that at some point prices can stay so low that you will you shut in production and then you start to balance the market. The reverse is also true, which is the cure for high prices can be high prices. And what I mean by that is if we're seeing record high numbers here in the United States, even with tariffs out there, it may make sense for pretty much every supplier in the world to ship their aluminum ingot here to the US. Their aluminum ingot, their common alloy, whatever it is, because even with respect to the tariffs and with respect to the higher Midwest premiums, there still may be a gap in people being able to send imported product into the United States. So at that point, what happens? You then get an oversupplied market. You may get some consumers who are saying, you know what? I don't really like buying a whole lot of metal at record highs. I'm going to go to the sidelines on 5, 10, 15% of my buy. And when those types of things happen, you can see knee-jerk reactions to the opposite direction. And again, I don't know if that's going to happen here, but at some point, at some price level, that does happen. And it feels like we're getting into that territory. And Harbor Aluminum, which is a subscription research company that covers aluminum very, very well, they've rightly been pretty bullish on aluminum over the last, I'd say 6 to 12 months. They are now noting that P1020, which is primary aluminum ingot, they are noting that spread is now high enough that it can attract imports. So is Harbor correct this time? I'm not going to call them wrong. They've certainly been pretty spot on over the last several months. So they've had some good content. They've had some good calls. And I think numerically it does make some sense because we've run through the spreadsheet of if you take $1.30 on LME, you add in some freight and logistics, you add in the tariff. My math says that premiums shouldn't be as high as where we are right now, which is right around 85 to 90 cents. My math would say that number should be a little bit lower, but it won't go there until or unless you start to get some threat of another supply chain, another import source. But I think if we give it a little bit of time, we might start to see that. I was actually on a call with Aluminum Market Update, which is a sister company of Steel Market Update earlier this morning. And I asked them the question, I said, at what price do you think the import arbitrage, meaning the spread, at what point do you think that opens? And their quick response was, it's open. And they think that imports are going to start coming to the US, even with a 50% tariff in place. And they also thought, not just on ingot, they thought that on common alloy, what exporters coming into the US would do is they would just tighten up their conversion a little bit if they had to make sure that it priced competitively. So I'm not saying definitively that we're seeing a double top at record high numbers, but it certainly, we are getting into that rare air where people might change some buying patterns. importers of aluminum may be looking at the rest of the world saying, let's bring it in. The value is there. So that could be something that we see. What's interesting is when we look at traders, so money manager positioning, they too are positioned about as bullishly or as long as they were back when we hit record high numbers. So you can see this is going all the way back to 2020. And what this number represents, it's 131,000. That is the number of contracts that traders are currently net long on the London Metal Exchange. And for those who want to know what a contract is, a contract represents 25 metric tons. So traders have been and have gotten over the last 6 months or so have gotten very, very bullish, and that has an impact on pricing. And we're not too far from the record long positioning that they would have had back in early 2022. But it looks pretty darn similar to the pricing chart when you think about, how traders can move markets around.
Real quick on the back to the aluminum or the Harbor P1020. We don't talk a lot about that on here. What is that? Why is that particular highlighted?
Yeah, so P1020 is it's the technical term of calling it aluminum ingot.
Okay.
So it's just the industry terminology. So you could swap that out and just say Midwest aluminum ingot in the United States.
Got it. And we got a question from the audience. I think it's a good one here about, so the tariff is residing in the Midwest premium.
Yep.
So any thoughts really what's causing the LME to climb then?
Yeah, so I think the LME is getting benefit from a couple factors. One is a weaker dollar, which tends to act as a tailwind for commodities. I think there's a little bit of a knock-on bullish impact to aluminum that's coming by way of copper, because whether we like it or not, sometimes copper and aluminum tend to trade not in lockstep exactly, but there's the assumption that if copper markets are doing really well from a pricing standpoint, that other industrial metals should also be doing well because they kind of go into similar end markets. So I think aluminum has gotten a little bit of a tailwind from copper moving higher in the last several months. But yeah, I think those two factors have really been it. And one thing I didn't note when we first touched on this slide was we did in the last few weeks break out of that, let's call it 3-year trading range. So we are in slightly new territory with regards to pricing, right around $1.30 a pound. Do I think that the fundamentals fully support that? A lot of the data I see is that estimates are saying that we're still going to be in a surplus both this year as well as the next 2 years. So fundamentally, I wouldn't say we're running out of aluminum, but little things like what happened with Novelis at their Oswego facility, I think that caused a little bit of panic, a little bit of scrambling within the aluminum world. I think some of that can feed into this. But again, I think the other factor is sometimes traders, like this chart shows, sometimes traders just get really bullish and they can move the market around. And it could be as simple as that. Just some trader wants to move the market higher and they take a lot of long positions on the London Metal Exchange, and that has an impact too.
There just seems to be so much going on with aluminum. I was talking with Jeff Notice earlier this week. Listeners might know Jeff. He's been on the show multiple times, supply chain manager, really concentrated on aluminum. And he was mentioning that mills have raised their common alloy conversion pricing. Like, you think it said to 25% a pound year over year. I mean, that's pretty, I mean, that's another thing, right? Putting more pressure in that scrap. Scrap's really tight. So it just seems like there's a lot going on. And that's kind of what the anticipation was, right? When tariffs kind of rolled out and we're saying, the biggest impact could be on aluminum. And here we are. We're seeing so many things playing into the aluminum pricing these days. Yeah,
for sure. And what's a bit tricky about it is, I mean, just how fast we've gotten to this point. I hate to say, history doesn't repeat, but it often rhymes. This chart, it just looks so ominously similar on the way up to what we saw back in 2021, 2022, just the speed at which you move up. And unfortunately, what we saw last time back in early to mid 2022 was what goes up must come down. And it came down just as fast or faster. And I mean, when we have that type of volatility in these markets, really nobody in the supply chain benefits from that type of volatility. And I mean, this doesn't even contemplate the possibility that the US and Canada may at some point come to an agreement and maybe lower the tariff rate from 50 to 25 or 50 to 0. I mean, if those sorts of things happen, I mean, look out, the volatility is going to be absolutely insane. But all we can do is talk about the possibilities and the probabilities and make sure people are aware, because it can go higher. It can certainly go higher too.
I think a question, and I've always had this, right? So you noted the fire at Novelis, right?
Yep.
And when they come back online, they're probably going to prioritize auto, can, right? I mean, those are the top ones, right? That have the most demand, if you will. I guess where in line then is the industrial aluminum, right? I guess that's more of a question for the mills, but you know what I'm getting at? It's like, okay, then once they start ramping up, does that put industrial aluminum consumers further behind the eight ball?
Yeah, I mean, it can. I know last time we hopped on, or maybe two couple of Joes ago, we talked about the A word, which is allocation and the possibility of that. I wouldn't say we've seen that in great detail within the industrial space. And if we were going to see it, we probably would have seen it, over the last 30 to 45 days with the Novelis fire as like automotive shifted their supply chains. But yeah, it is a possibility. But I guess to reassure our coworkers and our customers, we do. Jeff Notice and his team, they do a very good job. It's not me, it's Jeff Notice and his team. They do a very good job of aligning these contracts such that we have pretty certain supply chains, even with disruptions. So, you may say we take a back seat to automotive, but we're still a big buyer of aluminum, and I think we're pretty valued. We as Ryerson are pretty valued customer of these supply chains.
Yep.
All right. A couple new charts that we actually haven't spent a whole lot of time on, but the one on the left-hand side, I guess we've sort of spoken to, but it just shows the allocation of the import world within primary aluminum and who ultimately sells into the United States. You can see it over the last 5 years, how it's shaped, but ultimately Canada and the UAE are very, very important partners of the United States. And, we think about that tariff rate. If the tariff rate between the US and Canada is to make any adjustments higher or lower, it has an immediate and direct impact on the price of Midwest Premium, which has an impact on the cost of aluminum. So we want to keep a very close eye on Canada, certainly the UAE, although I think the odds of a UAE tariff exemption is probably much lower than Canada. But I thought that was a somewhat interesting chart and how that's evolved over the last few years. And then on the right-hand side, I noted the fact that pretty much everybody and their brother is making money at these prices. It's basically the exact opposite of what's going on in the nickel world, where given that we now have LME aluminum at, let's say, $1.30, we've got premiums at 85 cents. That puts ingot at $2.15. There's not a mill in the world who shouldn't be making money right now, unless they just don't have any electricity coming in for whatever reason. But you can see, you look on the bottom axis, it's estimated that everybody in the world, given their power contracts, their alumina costs, their labor costs, every single mill should be making money right now. And I would say anybody who can't find a market to sell their aluminum is probably going to be looking to the United States saying, they may still be the best market out there. The pricing makes sense. Let's ship it there. And that's why I think at some point you start to get some headwinds on price and things calm down a little bit and markets balance out a bit. But yeah, that's all I'll say on that. And then I noted this, but most of the bank forecasts are that we're going to see, at best a balanced market, but possibly some continued surpluses of aluminum. So from a fundamental standpoint, very few analysts are calling for shortages on a global basis of aluminum ingot. So I think that's going to help to keep things in check on a global basis as well. All right. Now, last but not least, our friend copper. We'll quickly breeze through this. We have seen a little bit of continued move higher on both the London Metal Exchange price as well as the COMEX price. I touched on the why last month, but we did get a little further intel on this incident, which is the mudslide, the mine accident incident at Indonesia's Freeport Grasberg facility. This is a very, very large mine, 3 to 4% of global supply for copper. And the latest we're hearing is that this shutdown, this outage is likely going to last not just into early 2026, but most likely for the majority, if not all of 2026, and could be something that we don't even see it ramp back up till 2027. So, I don't want to fearmonger or anything, but certainly 3 to 4% of global supply, that's a big number. And it's a particularly big number in the face of what looks like a world that is trying to become more technologically centric, more AI centric, which all of this is going to be a strain on the electricity grid due to copper needs. So copper remains a pretty tricky market, certainly a tight market. It's not one that we play in as much as the others that we ran through, but we know that all of our customers have some exposure either directly or tangentially to copper if they're manufacturing anything. So it matters still.
Especially all the technology we're talking about, right? I mean,
That's
copper
right.
plays a huge role in that.
That's right.
All right. Well, great stuff here. I don't know. I said you're a very cheerful man at the top of the hour, but now you told me my turkey's going to cost more, and who knows what this is. Yeah, jobs market. So I don't know. But okay. But we got a few we got a few questions from the audience here. If you want to put on your question and answer hat for us.
Let's do it. Let's do it.
Mostly related to the steel slides. Where do you expect the cold rolled premium to go as we move into 2026? Do we know anything about the cold rolled premium? Do you expect it to stay around 200?
Yeah, I do. I think what's weird is we're seeing a whole lot more volatility on the galvanized spreads, and I don't have a great explanation as to why that's occurring. It's getting slammed very, very tightly, and I just don't think that that's real sustainable. On the cold rolled side, yeah, I think probably 180 to 220 is a pretty healthy, safe spot to peg that. I don't see any deviations that would suggest that like the automotive market's going to get wildly tight and cause that spread to widen out. Nor do I see anything really on the hot rolled side, maybe like energy or something like that, that's going to go in a crazy different way. So long story short, I would say 200 is probably a good average benchmark for that spread.
Are we still seeing premiums on coated additives too?
The premiums on so if we're just looking at the spread from hot roll up to the galvanized price without the coating extras, it's trading at like $90 to $95 a ton, and normally that's in excess of 200. So that's a really peculiar space right now. On zinc actually has been pretty well supported in recent weeks. So I think with regards to coating extras, probably going to see those maybe a little higher.
Okay. Another question that came in, it was a little longer, and I apologize. I'm going to try to consolidate this into, and I'm hoping I'm asking the question the right way. So,
Okay.
what I get is basically if demand rebounds quickly in 2026, 2027, and tariffs are staying where they're at, what happens to mill capacity? Basically, could we see a situation like we did during COVID, where tight supply and higher prices, or do we think there's enough global capacity to help offset it?
It's a really good question. I think if we're looking at steel, and let's use hot roll coil as a proxy, I think if we were to get to the point where mills are operating not at, let's say 78, 79% capacity utilization, but instead somewhere closer to like 90 or basically as hard as they can go, run the mill as hard as you can go. If we have demand such that we're in that type of scenario, I think pricing basically just has to go to wherever we would call it marginal cost of supply is. And that would be your next best option, your next cheapest source of foreign steel, because we would then be over consuming just our domestic supply. So where is that pricing? I think if we're just doing quick math, I'd say if you've got scrap at 400, I think a domestic or any mill, if you've got scrap at 400, let's slap 250 on top of that. That puts you at 650. Maybe to import it here is $100, puts you at 750, and then put a tariff on top of that of 50%. That probably puts your marginal supply cost somewhere around $1,100, let's say. Maybe $1,050 to $1,100. So if things did get really, really tight, we likely wouldn't see a whole lot of importation threats until or unless we get in excess of $1,000.
Okay. All right. Good stuff.
But if we do get up there, you would expect to see Algoma probably changing tune and saying, "Hey, we're right next door to you guys. Our shipping costs are so low. We were selling you steel at $750. We'll absolutely sell you steel at $1,000."
Exactly.
So I think some of those neighbors would come back as well.
Good point. Okay. We got a question here about some of the industries. You usually have a slide in there about industries. It's just so funny. Whenever you take a slide out, people ask about it. So
I tried to update it this morning, and I sincerely apologize to all our listeners. But yeah, the government data does not exist, unfortunately. So I was unable to do that. So if we're rooting for anything for a reopening of the government, it's to get all of our content back for Cup of Joe.
Yeah, I mean, I did hear President Trump say that we got to get it going because Cup of Joe's data has been lackluster the past month.
That's right.
But this question is data showing signs of soft demand on truck sales, ag? Do we know anything then about that?
Yeah, I mean, I would say the headwinds still exist for agricultural equipment, whereas tailwinds exist, I would say, for construction equipment. So it almost like that Caterpillar is doing quite well right now, whereas somebody like a John Deere or an ag related company is probably having a bit more headwinds. Yeah, I would say that theme is continuing for now. On what was it? Transportation equipment?
Transportation ag.
Yeah, transportation equipment still looks pretty darn soft. I think that likely continues into at least Q1 2026.
Yeah.
Forecasts for build rates don't look too wonderful. So yeah, those headwinds still exist, and yeah, I would say continuation on the other side of things. I think we beat that to a pulp, where there are aspects related to data center and the big tech hyperscalers that are just thriving right now.
And I love Cup of Joe listeners. They hold their feet to the fire, so we can close the loop on a few things from last episode. The Cubs did win. They moved on to Milwaukee. Took it to Game 5, and the Brewers won. So I owe your analyst lunch, which I've yet to pay for. So wait till next year. We'll get there sometime. And then you mentioned earlier you took the drive to Ohio. Is it for the pumpkin drop or pumpkin punch?
I was back there both for the Buckeyes as well as for Pumpkin Show, and
okay.
Yeah, it was like 75 degrees. It was bustling in there. I think they got like 350 to 400,000 people in the small town of Circleville, and unfortunately, the pumpkins were not as big as what they traditionally are. I think the biggest pumpkin was like 1,950 pounds, which it missed last year by like 300 pounds. So just sad state of affairs in the growing industry right now.
Inflation, reverse inflation on the pumpkin side.
Shrinkflation. Yep.
Yeah. Any predictions for the Buckeyes?
They look good. They look good. I don't think they've put it all together yet, but Indiana's crushing people right now.
Yeah.
I think this weekend's going to be a pretty interesting one between them and Penn State. Ohio State, Purdue. I don't think that one's going to be a real exciting game, unfortunately. But I think we got a crash course between Ohio State and Indiana for the Big Ten championship, most likely. And
it's good to see Indiana. Yeah,
playoffs should be fun.
Yeah, I don't recall Indiana being as good as they are this year. It's good to see.
Cignetti's a real force.
Yeah. All right. Great stuff as always. Next month we're gonna hold your feet to the fire. The predictions you made in January. That's always a fun episode. Any closing thoughts for the crowd here?
No, I guess go easy on the predictions. I know for a fact that I've missed a couple of them, but it'll be fun to see what the hit rate was from the beginning of the year to where we are now, because we've been through a journey throughout the course of this last 11 months, both from a supply chain standpoint, a headline announcement standpoint. But no, I think the main takeaway is just as we head into holiday season, probably going to see some seasonally softer times with the manufacturing. Enjoy it with the family. Take that extra time and enjoy it with the loved ones. That's really all I got. Hopefully I wasn't too negative on today's Cup of Joe. No. It is admittedly a very interesting market though right now, where you have just such large dichotomies across the economy. So
definitely,
that's really where I'll leave it.
Agree. All right. Thanks everyone. We will see you next month.